Hi everybody, I'm Sahil Kapoor. I head the products and market strategy at DSP, and today I'm very excited to bring to you a great offering, something which is probably a fund that is for the future, for the long term, uh, an investment idea which is very unique from what we have in the marketplace today, and an investment idea which has very sound foundation. So I'm going to present to you today about the DSP Global Innovation Fund. What is the fund structure, what is the foundation, and what is it trying to capture, and what kind of investment journey can we expect. So this is what we're going to learn today. So this fund which I'm talking about today, the Global Innovation Fund, stands on three pillars. The foundation is on three types of businesses. So these three businesses, as you see on your screen, they are the dominators, the enablers, and the young disruptors. Dominators are the companies which are already very big, or they have very large market share, or they are growing at a fast pace within the segment that they have created. That means they have disrupted existing businesses and created segments which are growing at a fast pace, and they are able to, uh, you know, benefit from these changing dynamics of the business. So these companies generally are very large in size, and these are the companies which are very profitable in nature. Their profitability is very high. So these type of companies are called dominators. You can see there are Apples and Amazons of the world, or Tesla, which has a very high market share in the segment that it operates in. Similarly, Netflix or Adobe. Then there are companies which are enablers, companies which allow these companies to do their business. So for example, an EPAM, which writes software codes, or Intuit, which is a semiconductor play. Semiconductor, for example, is the plumbing for the whole innovation business. Nvidia, again, which creates chips and other businesses. The GPU chips which are coming up, allows other businesses to scale up very fast. All the devices that we see around us are now getting new GPU chips. By 2023, I think the transformation will start. Or for example, a company like Trimble, which is into the construction, infrastructure, agriculture space. It does geospatial mapping. It provides automation and technology solution to these sectors. And we all of know that infrastructure is gaining significant steam globally, and this company is a market leader in this space. The third segment, which is extremely interesting, is young disruptors. These companies are probably, at an early stage in their disruption cycle. They are trying to create new businesses like a Zoom or a Twilio. Zoom, as you know, is a platform that all of us have used. Roku is a streaming company, which created something like the Amazon Fire Stick. It did that maybe 12-13 years ago. It has its own internet stick, which you can use in any kind of device. So these companies, for example, DoorDash, you already understand a model which is similar to many existing model in India, where they deliver food at home. They also operate a lot of cloud kitchens. Genome editing, again, you would have seen advertisements where people talk about medicine which costs 10 crores, 20 crores, and they are not able to afford it. These are the therapies which were created in the last 4-5 years using the genome editing technologies. And these gene therapies are very costly today. So some of these companies are probably going to become very large in the future, probably larger than they are today. And these young disruptors, many of these companies are probably going to be very large companies in the future. So what this fund does is it tries to create a triad of three types of businesses, these three, and roughly in an equal weighted format. So the fund will have 1/3 of each of these, the dominators, the enablers, and young disruptors, which will eventually create the foundation of the fund. Now there is a very important message on why we have selected this kind of a structure. So if you look at dominators, they provide stability. They are generally very large in nature and very profitable. Enablers provide good, strong profitability again. Many of these companies are B2B, and they are profitable, or they're going to turn profitable very soon. Young disruptors, on the other hand, are the companies which are more futuristic in nature. Their businesses are going to evolve in the future. For example, a case in point, Square, it has turned profitable just last year, but between 2012 and 2021, its revenues grew from 200 million to about $17 billion, right? So the scale of growth is tremendous, but the profitability will come 5 years from now or 3 years from now. And the possibility is that these young disruptors and some enablers will go and become dominators. So this is the core of the fund. It is trying to capture that some of these companies will eventually become market leaders, and it will try to capture these companies. How and when and what is the structure through which this will be possible, I will showcase you later. Another important aspect is, if you look at these companies which are the winners of today or which are already proven businesses, you can see that these have become very strong dominators in the market. If you bought these companies when they were included in the index, you can see the data. For example, Apple became 13 times after it was included in the index. But if you had bought Apple when it IPO'd, the returns are 1293x. Very, very large returns. Similarly for Amazon or a Tesla or an Adobe or a Netflix. The idea is that if you are able to catch these companies, which are the dominators of today, when they are early in their cycle, that means they are either young disruptors or enablers, you will be able to create tremendous returns. The alpha will be very, very large. So this is what the fund is eyeing, an equated kind of approach in these three type of businesses, and trying to capture some of the enablers and young disruptors becoming dominators in the future. So this is something very, very special in terms of the structure, which probably is unique to this fund. Now the question is, why do we want to capture innovation now? So if you look at history, last 200 to 50 years, you will see that there have been a number of innovations and revolution which have changed how global GDP moves. So for example, the invention of steam engine or railways, it created a huge amount of economic impact. Similarly, telephone, automobile, electricity created huge economic impact. Economies grew, opportunities started flowing. Lot of companies made a lot of money because of these innovations. And if you remember, there were roaring 20s, because of the upfronted innovations in that period. The stock market enjoyed a huge run in 1920s, not only in US but globally. Similarly, there were rallies even in prior periods. Then about 30-40 years ago, we had internet and computers come about. Now what we are seeing is that there are a number of technologies on the block which have the capacity to become very, very revolutionary in nature. So earlier we had technologies once in a while, maybe an internet over a 20-year period, which was preceded by computers, electricity, automobiles. They came in patches, but right now we are seeing that there are a number of contenders which have the capacity to transform global businesses completely. Whether it is blockchain, genome sequencing, robotics, energy storage, artificial intelligence, these businesses, these sectors, or these technologies, they have gained critical mass now. So for example, let's say there is a deep fake video today. It's very, very difficult for the human eye to know whether a video is original or fake. But if you have a blockchain technology, or let's say a NFT, which is being used, that means it can verify that what is the original piece of art or a digital asset. It's impossible to manipulate it, or it is impossible to create another copy of it, right? But without, let's say, the blockchain technology, it's not possible. So these technologies are going to become mainstream in the next 10-20 years. Similarly, genome sequencing, which I spoke about in the last slide, I think in the next 10 years, this is going to gain popularity. 2020 Nobel Prize was given to two ladies who created the Cas9 CRISPR technique of gene editing. Similarly, for all the other aspects, you will see that a lot of these technologies are probably gaining critical mass right now. And why is it important in terms of gaining critical mass? Because these technologies are largely, it took a long time for these technologies to get formed. So the technologies that I spoke about earlier, and I named them general purpose technologies. If you look at this data on your slides, it took about only 4 years in the 21st century to create technologies like this. In the 20th century, or the previous one, it took about 15 years to create general purpose technology, right? And prior to that, it took many centuries. So the idea is that these technologies are here. They have gained critical mass over the last 10 years because of technological advances and because of the education, because of computing power. And then they are disrupting each and every business. And it is creating less and less time to create technologies like this. So in the next 10 to 20 years, it's very, very critical that we capture innovation as an investment theme, because it pays rich dividend. It commands premium valuation, which I will showcase right now. But before that, one very small story I'll tell you. Roger Bannister broke the 4-minute barrier to run 1 mile race. It happened in 1954, closer to that year. In 1903, one of the UK Olympian coach said that it's humanly impossible to run 1 mile under 4 minutes. So in 1954, Roger Bannister, broke that barrier, and a lot of people believe that it's a paradigm shift. That the thought process changed once that guy did it. Since then, about 7,000 to 9,000 people have done that. They have broken that 4-minute barrier. Even school-going children are able to run that. A lot of people believe that it was a mindset change. I see that as a change in terms of a lot of variables. Apart from the mindset, I think after the World War, nutritional levels improved, which was a very, very big change. A lot of people, gave a lot of time to their mental and physical well-being, and which eventually culminated into these feats being achieved. And that is why I think this critical momentum and mass has been built through years of education, a lot of computing power, advances in chip making, a lot of focus on these technologies and investments in these technologies. The tech boom of 2000 created a huge amount of capital being available for these sectors. So I think accumulation of all these factors have created these conducive conditions. And as investors, I think we are sitting at the cusp of benefiting from these cycles. So as I told you earlier, these technologies are probably going to be very, very critical in the future. Disruption, as you know, has driven a lot of change. Within the sector, you see that market leaders continue to change over time. In 1990s, you can see there were a number of market leaders. Only one of them, Intel, survived in 2020 as a market leader. A lot of these companies still survive, but they may not be the market leaders. Similarly, we don't know what will happen in 2030. So the pace of technological change provides two different aspects. One, that there is continuous change, continuous churn. So it is inherently very, very difficult. Secondly, it creates a lot of opportunity. If you remember what I showed you at the beginning, that if you had bought many of these companies which are dominators today, when they were in the IPO stage, when they IPO'd and got listed in the market, the returns would have been very, very meaningful. So changing leadership allows you to have many such opportunities, and actively managing your investment in this space pays rich dividends. It creates a possibility of gaining more ground, gaining critical alpha on your investments. We looked at a study earlier, which showed these companies not only have shown significant price performance. So if you look at this chart on your screen, the blue colored line shows you the stock returns over the last decade for a number of these dominator companies which have already showcased that their business models are solid, right? They have also shown very, very significantly strong earnings growth, upwards of 20%, in some cases upwards of 50% also. And that is why their stock prices have performed very well. That means if you were to do this data, let's say 1930s, and looked at, let's say, railroad stocks or other stocks, or internet of 1950s and 60s computers in that era, or let's say automobile companies at the end of 1890s or so, you will find that these companies are able to command a lot of market premium. They are able to command a lot of earnings growth. So this innovation theme is not a cyclical theme. It's a structural and a secular theory. It's a sector which continues over many, many centuries. And the idea is that the type of companies may change, the type of businesses may change, but the hardcore innovation theme stays. So for example, right now the innovation theme is dominated by IT, technology, gene technology, mobility, sustainable energy, robotics. At some point in time, it will be very different. So, for example, when oil fractional horizontal drilling was discovered and invented, I think that would have dominated the innovation era of that period, right? So, innovation type will change, but these companies will continue to command a lot of earnings growth and a lot of premium at the stock market. So if you look at this study that we undertook and looked at a study from Wharton from 1962 onwards, $1 of investment in high R&D companies, or what we call innovators, became 45 times. But for low R&D companies, it was just 12 times, right? So it clearly showcases that companies which invest a lot in R&D or in innovation, they command a lot of premium. They are able to create new markets, they are able to create new businesses, they are able to get market share, and eventually that is what drives the stock market performance also. So I think even historically this data has been there for a very, very long time. So from 1980s onwards, a lot of companies started doing a lot of R&D on intellectual property, on software aspects, and I think that is how these companies have grown, and they continue to grow. So on a totality, when we look at the Global Innovation Fund, the core companies in this fund has an R&D to sales expense of more than 20%. Some of these companies are very, very high, but on an average, the overall fund is closer to 20%, which is a very, very strong number, and tells you that the fabric of the fund overall is driven by innovation. Inherently, innovation is not easy. You see that the company that I'm showing you have a lot of survivorship bias. For every WhatsApp messenger, there are a lot of failures which have not been able to make it. For every Facebook or a social media giant, there are a number of other businesses which could not scale up, right? So it is inherently difficult. Sitting, let's say in 2003, all of us would want to know that who is the next Steve Jobs or who is the next Elon Musk sitting in 2014-15. But we don't know, and even we don't claim to say that we know sitting today. But there is a possibility to create a structure that can capture some of these opportunities, right? So there is a possibility that this fund will be able to capture the dominators or the successful themes of the future of all the sectors and all the technologies that I showed you at the beginning. And how will that happen? So this fund solves three very, very key problems, and therefore is able to do what I said. So there are three very important risks when you invest in innovation. First is the thematic risk. You might end up being very, very concentrated towards one theme. For example, investing in internet and IT stocks in 2000, it took 8 to 9 years for your fund to turn around or your investments to show you green. Therefore, what we've done is we've looked at this fund from a sectoral perspective, and this fund is extremely wide in the number of sectors it invests in. So if you look at the tentative weights, semiconductor is around 29%, software at 24%, internet and interactive media at around 11%, biotech and healthcare 6%, e-commerce 7%, fintech and payments at 6%, mobility at 4%. Others include robotics, construction equipment, all the other industrial robotics which are available. So on the horizon, this is not an internet and technology fund. This is a fund which is across themes, across sectors, which gives it a very, very strong footing in terms of reducing a particular sector or a theme risk. This is one of the key risks in innovation, and this fund addresses that by going across sectors. And I think that gives it a very, very strong footing. Second important risk is that when you invest in innovation, you don't know which companies will survive and which will become very, very large. So when you look at the structure of this fund, and I will address that issue, it invests in 6 managers. All these 6 managers are very, very complementary styles. So there are 30% passive. So if you look at these two funds, the iShare Nasdaq 100 UCIT ETF and iShare Semiconductor ETF, also called SOX, in totality 30% of passive funds. And there are 4 active funds, 15% in Morgan Stanley US Insight Fund, 15% in ARK Disruptive Innovation Fund, 20% in Blue Box Global Tech Fund, and 20% in BGF, BlackRock Global Funds World Tech Fund. So this is in totality how the fund structure looks like. And because there are 6 different active managers, all these managers are complementary to each other. So when you look at an ARK Disruptive Innovation Fund, its strategy is to focus on disruptive innovation. Similarly for Morgan Stanley. And these funds are very different from a Blue Box fund, the World Technology Fund, which looks at well-established and enabler companies, companies which are highly profitable, or they are going to turn profitable in the near future. Similarly for BGF, a very well mix of all the 3 ingredients. The key point is that when you look at one manager and when you look at its active weights, they are very different from the other managers. For example, the overlap between ARK and Blue Box Global Tech will not be more than 1.6%. So it's just about a stock which is similar. All the other stocks are very different from each other. So in totality, why these 6 managers? Number one, once we accumulate all these strategies put together, and we have eliminated a number of them, before these 6 were finalized, it brings you closer to 240 to 250 stocks in the fund. No stock will have a weightage of more than 3 to 3.5% at the max. I think the highest weighted stock is at 3.4%. Top 10 will be closer to 13%. So the fund is very, very diversified, and that allows you to capture a number of companies. So for example, as I told you earlier, gene technology as a sector, I think, is going to probably become very, very large in the next 10 years. How do you capture it? How do you know that one company is going to become the market leader? There is no way to know it. So what this fund does is, because of its structure, it will go and buy all the key companies which have the conducive conditions to deliver the next big large cap or next big dominator in that theme. So it will go and invest in most of those companies which are fundamentally sound. So the wide number of companies eliminates the stock specific risk, or reduces it, not eliminates it, reduces that risk, which allows you a very, very well diversified portfolio. We looked at innovation investing very, very deeply, and we found that concentration risk in innovation investing is very, very high. So when you look at, let's say, investing through an index or a passive strategy for innovation, what it does, it gives you an exposure to, let's say, FAANG or NYSE plus FAANG type of stocks, which is very, very concentrated. We feel that a very well diversified portfolio gives you much better investment journey, much lower volatility. So this is the risk number 2 that it eliminates. The risk number 3, which is the manager risk. We've seen historically, when investing in innovation, manager risk is very, very high. Some managers go through a period of underperformance or outperformance. So what we have done is we have chosen complementary managers which can balance out performance over time and deliver a smooth investment journey. So these 3 risks are eliminated, as I told you, or reduced. Thematic risk, second, company specific risk by diversifying, and the third is active manager risk. So the mix of strategies which is being delivered reduces the active management risk, and it also increases or makes the investment journey much more beneficial. When you look at the long-term investment journey in this fund, what we've seen historically, data shows that if you do a basket of innovation-oriented funds, and we looked at data from 2002 onwards, and the SIP return for this kind of basket is 19.3%, which is very, very strong in comparison to, let's say, Nifty returns, which are 15.2. All these are INR returns, or even in lump sum. So one key risk this theme brings in is more volatility, because these companies, many of these companies are in a transformation stage. They are transforming themselves. They are trying to transform their businesses. So their stock price volatility could be very, very high. And therefore, innovation investing is best done through a systematic investment plan. And that's how, the data has also highlighted that doing a SIP delivers much stronger returns rather than looking at lump sum investment. So we feel that, investors who want to invest in a global innovation fund or a structure like this are better off investing through a SIP route. Even on a 10-year rolling returns basis, if you look at the basket of innovation-oriented funds, they have delivered better. How to look at this data? Pick up any date from 2002 onwards, take a 10-year horizon. This will be the average return. So these returns are not case in point. These are not bottom and top returns. So any period you pick, they deliver good, smart returns. And I think that's a very, very healthy practice to look at in terms of rolling returns. And therefore, systematic investment plan, a more disciplined approach to this investing is key. So just to summarize, innovation investing, I think, is best done through a well-diversified portfolio, eliminating different biases. This structure tries to reduce three types of risk: thematic risk, company-specific risk through diversification, diversification across sectors and theme, and diversification across companies. And the third is the active manager risk, where a number of complementary styles are chosen rather than a single manager or a passive strategy to reduce risk of performance and provide a smooth journey. And the fourth type of risk, which is time risk or the volatility, is being addressed by using a systematic investment plan. So this is in brief about Global Innovation Fund, and we are happy to look forward to responses from you. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.